Hello, Bob and Karthik. Thanks so much for joining us for another eLedgers Explained video. This video is also going to look a little bit different from some past videos. We're going to be diving deep, particularly into a recent publication from both of you called eLedgers Carbon Accounting, which is diving into kind of more of the accounting intricacies of the e-liability framework. And so we'd love for you guys to just kind of walk through some of the ideas presented in that paper in detail and go from there. So I'll kick it off to you guys.
Thank you, Sandy. And we're very excited to be able to introduce and discuss this paper, in part because this paper brings together the e-liabilities and the e-assets concepts in one place, and it does so with the necessary journal entries if you want to track this using the double entry bookkeeping system. It also introduces or clarifies, I should say, some of the questions that people have, like, well, what happens when at the point of the final sale to the customer, the end consumer, that is. So we talk about this, of course, in the original e-liability paper from 2021. We've also talked about it in the e-liability proto-standard, but in this particular paper, we articulate very explicitly what are the journal entries associated with that end customer transaction or end consumer transaction. And therefore, as a result, this paper introduces beyond the entity ledger for, say, a business or a nonprofit or even a government entity, it introduces the jurisdictional consumption e-ledger, which is where these consumption records will be tracked. And another question that we often get asked, and again, we've implicitly addressed this in our previous writings, is what is the offsetting entry when a direct emission is created? So yes, you recognize the e-liability, but what is the offsetting entry? So in this paper, we get into those details and in particular, introduce this notion of the geological carbon equity account if you want to track these in a double entry system. So we're going to introduce some new terminology, where obviously the concepts are all the same. Everything is effectively fully consistent with the 2021 paper and the 2023 paper, but it gets into some of the weeds and the details, including the specific journal entries and some new concepts to make those all hold together. So with that, I'm going to turn it to Bob, who's going to explain the first in the series of novel journal entries associated with e-liability accounting.
Well, thank you, Karthik. And you will see that actually there are only 3 types of journal entries that are required for this entire system of e-liability accounting. And we're going to go through each of those 3. And the first one is how do we move emissions from one entity to another entity? And this was the basic motivation behind the invention of e-liability carbon accounting, which was how do you trace carbon emissions through very complex supply chains? And we rely on these accounting fundamentals is move it downstream from upstream organizations to downstream organizations. And as you'll see, when you do it in that direction, it becomes extremely simple. So the first journal entry is when a supplier sells a product with emissions that are already recorded to that product in a process that you'll subsequently see to a customer. And the journal entry is very simple. You debit the e-liability account of the supplier, and you credit the e-liability account for the customer. So as with typical accounting journal entries, you have a debit and a credit. Now, but even in this very simple accounting journal entry, there's novelty. And the novelty is that this is an inter-organizational journal entry. And in all of financial accounting, there are no inter-organizational journal entries like this. Journal entries are within each of the entities. But because this is basically a supply chain tracing methodology, we need this inter-organizational entry, which is to reduce the e-liability account of the supplier and increase the e-liability account of the customer. And so that's the first entry. And we now have the emissions associated with that purchased product, starting from its origin, whether it was on a plantation or an oil field or extracted out of a mine, reflected in the product that has just been purchased. Karthik, why don't you take over for the second journal entry?
Thank you, Bob. Yes, the second journal entry basically deals with direct emissions into the atmosphere. And so, of course, when a company is engaged in, say, this kind of direct emission, maybe this is a company that is, producing steel in a blast furnace. Maybe this is a company that is running an internal or an external combustion engine and is combusting fossil fuels. So there are certain direct emissions, and those direct emissions result in a credit on the entity's e-ledger in the e-liability side of the ledger. But then the question is, where is that offsetting debit? Where does it sit? Is it an inter-organizational debit, as Bob said? And if so, what is the entity with which that inter-organizational debit would happen? And for these purposes, we create what is called the Geological Carbon Equity Account. And the Geological Carbon Equity Account sits on the Geological Master Ledger. And we'll talk about the Geological Master Ledger in a bit. But on that master ledger, which has an asset column, a liability side, and an equity on the right-hand side as well, that equity account is the Geological Carbon Equity Account. And what that Geological Carbon Equity Account does is it tracks the geological store of carbon effectively in the earth. And it says, here for simplicity, we combine, terrestrial carbon with oceanic carbon, and we call it all geological carbon. But basically, what this is saying is that when you take carbon out of these long storage sources and you put them into the atmosphere, then you are effectively drawing down on that geological carbon equity store. So when you've credited the e-liability of the entity that has emitted that, you are debiting the Geological Carbon Equity Account, which represents, in some sense, the Earth's store of carbon emissions. And that is the second entry. And of course, why that matters is because we want to have some sort of mechanism through which we account for the Earth's store of geological carbon and drawdowns and accretions to that store, which is what the accounting does. And so this account is the basis for the use of double entry bookkeeping in this particular context. Let me make two quick footnotes there. The first is there might be this question of, well, whoa, who will even maintain this account and so forth. We'll talk about that in a moment. And the second is to emphasize that if you wanted to, as a matter of simplicity, run this system without this geological carbon equity account, at least initially as we get started and so forth, that's entirely possible because you can run this system on a single entry basis without someone keeping track of this geological equity account. And that is something that can be added on very much later. So we wanted to introduce this as a basis for the conceptual clarity and the conceptual consistency of the e-ledger method. The third type of account, Bob is going to take up next.
Yeah, but just to add a third footnote on what Karthik just talked about, this is the beauty of accounting, and particularly double entry accounting. Goethe, more than 200 years ago, says that double entry accounting is one of the great inventions of mankind and womankind. And I always, as an accounting professor, I often puzzled about this remark. But as we got into the carbon accounting space, you realize the wisdom of Goethe's remark, because understanding if I'm making a credit entry for my direct emissions, it forces us to think about, well, what's the debit entry? And that led to the invention of this global carbon equity account that Karthik has described, which is really a very important ledger for all of us to be keeping track on. So on the third journal entry, get back to the entity. It now has two sources of emissions, those it purchased from its suppliers and those it produced on its own. And the third and final step here is to take the purchased and produced direct emissions and assign them to the output products of the firm. And again, this is an important feature of e-liability carbon accounting, which is we don't operate at the entity level, we operate at the product level. That's what firms are producing, and that's why we have emissions in the first place. Now, the process of assigning the purchased and direct emissions to the output products is in a way analogous to cost accounting's assignment of factory overhead or corporate overhead to its diverse output products. That would include, expenses of machines and of indirect workers and the factory. Now, historically, and start now as somewhat older person, go back 40 years, that internal cost allocation was being done very poorly. They were taking this big blob of what cost accountants called overhead, which is another way of saying, I'm not sure what's here, but by giving it a name, I hope we can explain it. And they just allocated it fairly arbitrarily. And then 40 years ago, we introduced activity-based costing that says, no, that's not adequate for an expense that's 50% or more of your total spending. We have to find causal mechanisms for assigning the indirect expenses to the output products and services that are being produced. And so this was natural for Karthik and me 5 years ago when we were developing e-liability accounting to realize this was exactly the same mechanism that we need for e-liability accounting, is to get causal connections from the purchased and direct emissions to the output products, that end up being the beneficiaries of the purchasing and the production process. But in another difference between financial accounting and carbon accounting, the auditors of a company don't really care how accurate their internal cost accounting system is. As long as in aggregate, the split of expenses between cost of goods sold for the period and finished goods inventory is about right, they're happy. But that's not sufficient for us. We actually, in carbon accounting, we need much better accuracy and granularity. And so this third journal entry, where we are going to, in a way, debit the purchased emissions account and also the direct emissions account that we will credit into the product, the output product, all the output products that are being produced. That'll be their e-liability. This has to be done accurately if the emissions, going back to our first transaction, when you sell that product to your customer, that those emissions have to be both accurate and verifiable. So there's a higher standard of accuracy and causality required in carbon accounting than we need in financial accounting for measuring the allocated costs to products. But anyway, the journal entry, if the purchased emissions come from an input material that shows up in the output product, are very simple. We're going to debit the purchased emissions account and credit into the output product account. Now, if the purchased emissions came from a piece of capital equipment, we don't want to allocate all those emissions to a single product in a single period. And so, the capitalized emissions, which is another ledger account, we'll have some allocation method similar to depreciation of how much of the emissions in that capitalized equipment should be assigned to these products in this particular production process. But there's still, again, simple, let's debit those emission accounts from purchased emissions, capital emissions out to the credit account of the output product that's being produced. And now you can see that now we have the emissions accurately assigned to each output product, we're all set to go back to the first category of journal entries, which is when I sell that product, I now debit that output product's emissions account, and the credit entry will be made on my customer's e-liability account for that. And that's why these 3 journal entries are comprehensive, completely exhaustive. They're the only entries we need to operate a global carbon accounting system for all entities, no matter how complex and diverse the supply chain is, except for one other feature or one other player. as Karthik hinted at in his introduction, what happens when a consumer is purchasing that output product with all those embedded emissions? Bob and Karthik, are you really saying we need 8 billion ledgers for each of our consumers in the economy? That would be a non-starter for e-liability carbon accounting. So Karthik, how are we going to handle consumers in this system?
That's right. So, as a practical matter, you can't expect 8 billion consumers to keep their ledgers. So, but it turns out that you can have the jurisdiction in which the consumer makes the purchase keep the ledger and keep track effectively of the emissions in that jurisdiction. This is actually very similar to how GDP accounting works, because in GDP accounting, the activity of the end consumer gets recorded on a macro ledger. And so effectively, when there is the final sale, then what we do is we will debit the e-liability of the entity that's making the sale, and we will credit the e-liability of the jurisdictional ledger. Now, this raises a number of questions, which are policy questions, which we talk about in greater detail in the paper. But, people will say, but doesn't this really then not create an incentive for consumers to care about their emissions? And we say that's actually not the case, because effectively, when the consumer makes the purchase, they still have the visible product label with the e-liability on it. And that becomes the basis for the consumer to make that purchase or not. So this is quite apart from where it is the emissions are transferred onto the ledger. The disclosure to the consumers still continues. And Bob and I have in a separate paper covered some of the disclosure principles for consumers or for sale of products to consumers. Another question that might come up is, well, how are we going to even know what the emissions at the consumer level are? Who's going to actually record those direct emissions? Well, so out as a practical matter, most direct emissions for consumers or at the consumer level are those associated with the use of internal combustion vehicles for, say, their personal driving, or for the use of fossil fuels in generators or in lawnmowers and things like that. The advantage of that, of course, is that if you know the carbon content of the fuel type, which, by the way, we already know from databases like GREET, and you know what is the quantity of the fossil fuel sold to the consumer, then you can, at the reasonable assurance level, impute what are the emissions from consumer use in any given period for the purposes of the jurisdictional ledger. So it turns out that jurisdictional consumption ledgers for emissions in a particular jurisdiction are quite simple to calculate at the reasonable assurance level in this setting. And that is important. These jurisdictional consumption ledgers are important for the purposes of the completeness of this system, because just like in GDP accounting, effectively, there is a value added through the economy up to the point of end consumption. And of course, when there is a post sort of consumption use of the product, then you don't count the emissions once more. You simply say, well, now any new emissions incurred in converting the product, say for its second use, those will be recorded on the e-liability of the company that engages in that conversion. But of course, the emissions from the previous cycle have already been accounted for, now sitting trued up on the jurisdictional consumption ledger. So those jurisdictional consumption ledgers are A, important to complete the chain, B, quite simple to maintain because of the imputation of emissions at the consumption level from just a few key sources, and C, do not necessarily create a disincentive for consumers to care about emissions. In fact, with proper disclosure at the consumption level, which we've addressed elsewhere, you can actually have that incentive and still have the flow of emissions. Yeah.
And it also provides visibility to the jurisdiction that if it wants to reduce global emissions, it knows which emissions are coming into its jurisdiction and which are being produced in its jurisdiction by the consumers and citizens, and that gives it a basis for its own policies to reduce the quantity of emissions coming from citizens in their jurisdiction.
That's right. Now, so far, we've only talked about the e-liability side of the transaction and effectively what happens, as emissions or e-liabilities move through the value chain from the source through the customers, then in direct emissions, and then, of course, with the allocation of emissions to products, and eventually to at the consumption level. What we haven't talked about is the e-asset side of this. And in the paper, we also talk about what are the journal entries associated with the e-assets. For the purposes of the brevity of this video, we're not going to go into those details. We already have a video on e-assets, which was made previously, and that is on our channel, so we can link that video. But the journal entries associated with the e-assets are, of course, important as well. Consistent with everything we said, they follow double entry principles as well. And importantly, the key sort of feature that we want to drive home is that when you actually engage in a removal activity, that is, when you generate an e-asset, what you're doing, of course, is you're debiting your e-asset because you've created this. And then the question is, where is the offsetting credit? And of course, the offsetting credit goes back to that geological carbon equity account. So you debit the e-ledger or the entity that creates the e-asset, and you credit the geological carbon equity account by that amount. So again, to go back to the Goethe quote, the beauty of the double entry bookkeeping makes it so patently clear how it is you should be accounting for this. And that geological carbon equity account, when you've credited it, you're saying basically to the earth, yep, we've restored the store of geological carbon that we had previously depleted by some emissions. So that geological carbon equity account becomes that anthropogenic truing up, or that truing up mechanism for anthropogenic emissions. So now, why do we want to create this geological carbon equity account? Well, one, like I said, it's not necessary, certainly, for the functioning of the e-ledger system, but it's a nice sophistication. It's a nice mechanism to have there for accountability purposes. And, when we eventually get to a place where we can build and sustain this, there's actually great value to having it because it helps us track the total geological movements of emissions and removals, which is of course important for the purposes of getting to some sort of net zero. And people might say, but my company has a net zero target or my country has a net zero target. But of course, the only net zero that really matters is geological net zero. So this geological carbon equity account is a really important tool to that accountability because it helps you tell at any one point where you are in that context. Now, what is another strength of the e-ledger system is that, of course, almost all entities in the world today are very, very far away from net zero. They're going to have far more e-liabilities than they're going to have e-assets. And so the whole purpose of the e-ledger system is to show that imbalance as it exists. And in fact, this is where there have been a number of carbon accounting attempts in recent years that have emerged after Bob and I wrote our paper in 2021 that have attempted to use double entry bookkeeping principles and force in some sort of double entry process for carbon accounting. And they hold the accounts of an entity in balance at all times. But that's kind of informationally useless because what you want to see is the degree of imbalance, like how much are the e-liabilities of the entity different from its e-assets. And therefore, at any one entity level, you are likely to see a net non-zero position, which is in fact the reality. And you don't want to obfuscate that reality with some sort of artificial constructed sort of balancing system of journal entries. But what you want to do is to be able to then add up all of those assets and all of those liabilities. This is a beauty of the e-ledger system, is that all emissions and all removals appear once and only once on a net basis across all entities in the world. So if you added up all the e-assets on a net basis of all the unconsolidated, that is to say, arm's length entities of the world, and you added all of those up and you calculated that, and then you added up all of the e-liabilities across all the unconsolidated entities across the world, you would put that on a geological master ledger. And then you take that geological carbon equity account and you put that on the geological master ledger, and guess what? It balances. Of course it balances. The assets equals liabilities plus equity. That is the fundamental accounting equation operating at the only place that it matters, which is at the geological scale. Because the whole point of this exercise is to get a geological net zero, not for any one company or any one country to get to net zero, for the world, the earth, to get to net zero. That is represented in this fundamental accounting equation. And that is the strength of the e-ledger system. Let me pause there and turn it back to you, Bob, for some closing thoughts.
Sure. So this is the essence of the e-ledgers. We've gone in detail on the e-liabilities, and we've previously covered the e-assets. There's a few other enablers for this system to work at global scale. One is, of course, we need auditing and verification. How do we know companies are not just making up the numbers or using some average number from some public database? But the auditing is actually much simpler in our e-ledger system because you can audit at the transaction level. You audit where the emissions occur. And in fact, you're auditing all the emissions that are sending emissions into the atmosphere. And subsequently, you just have to audit the transactions between suppliers and customers, and also that intra-company allocation of purchased and direct emissions to the output products. So those are the three journal entries. Those are the entries that need to be audited, and the auditing profession will need to engage to see how to do that efficiently. You don't have to audit at billions of these transactions. They already know that, and they'll work through the methodology by which they can get a reasonable assurance that these journal entries are representatively correct, fairly and truly present that. So it is easy to audit because you audit when and where the emissions occur. The second is, how do these journal entries move downstream? Now, in financial accounting, you can do complete audits just looking at transactions between a tier 1 supplier and the entity. But here, the tier 1 supplier is relying on entries that it received from the tier 2 suppliers, and so far down the line. So we need to have a technology by which not only the data on emissions through the journal entries are captured, but also the method of verification of those journal entries. And fortunately, we can do this today. We should not have been able to do this 20 years ago in a very secure, private, but still accessible method, which is through distributed ledgers. Blockchain and tokenization give us the IT that enables accurate, private, and verified information to move downstream in supply chains. So that has to be worked out, and we've covered that in another e-ledgers explained video. And the final is, well, you guys have described an idealized situation where every entity and every jurisdiction in the world is on the system. We're pretty far from that now. How long do we have to wait for this idealized utopian carbon accounting world to exist? And the answer is, you don't have to wait at all. You can start the process. If a few major downstream companies started to use this system and impose it on their tier 1 suppliers, and then help them work with them to some of their suppliers, we'll get a first pass at this. And then that will enable some of the downstream from those organizations information to be more accurate and verifiable. And you repeat the process. So this is what we call a recursive process. And we go through multiple iterations, perhaps once a year. But each time we do it, the scale and scope of the entities and the output products and services that are covered will increase and will increase geometrically. And we've covered this in another e-ledgers explained video. So we don't want the best to be the enemy of the good. We can start this tomorrow. And the more organizations that do this, and the more output products they work with, and the more of their input products from suppliers they work with, the faster that we can converge to this global solution through this recursive process. So auditing, IT, transmission of private secure information, and recursion and convergence to the global solution that Karthik just described are all covered in this paper and in some of our previous videos.
Excellent. Well, thank you so much, and to all our viewers, and thank you to Sandy for producing these e-ledger explained videos.